Welcome, everyone. Thank you for joining us for today's discussion on a young professional's path to financial independence. I'm Lachlan McLean, Wealth Advisor here at Equius Partners, and I am joined by my good friend and colleague, TJ Troutner, Managing Partner here at Equius. TJ, good to be here with you.
And you as well, Lachlan.
Thank
Thanks.
you. Yeah, this is good. TJ, you and I are really excited about today. It's an interesting subject, and it's an important subject. As a financial advisor, it's essentially what we do every day is help people achieve financial independence. What's most exciting is who we're talking to today, young professionals, people early in their lives, early in their careers that can make the most of the things we're going to talk about today. This perspective, this knowledge, you all have such potential ahead of you. And by making good decisions, that potential turns into really fantastic outcomes, which we're going to discuss.
Absolutely.
Based on our discussions, what I've loved most is, you've been an advisor here at Equius for 15 years now. You have just as good a perspective on what financial independence means as anyone that I know. And so I wonder if you could, if we could just start by you sharing that perspective and that definition of what financial independence really means.
Absolutely. The way I think about and look at financial independence is really in two ways. The first is how most people think about financial independence, and that's financial security. And financial security means different things to different people in different stages of life and with different levels of wealth. But if you think about a retired investor, somebody that's just entered retirement, what financial security means to them and financial independence means to them is that they've accumulated enough assets throughout their lifetime to be able to sustain their lifestyle for their retirement until they pass. And a lot of times to pass on assets to their children or to some philanthropic intent that they might have. For a young professional, financial independence and financial security is very different. Financial security for a young professional is they want to grow and maintain a lifestyle and hopefully improve that lifestyle over time. And they want to make sure that along the way they are building a nest egg to really make sure that they're protecting themselves from the things that life throws at us, right? So we've had a really, concentrated view of that over the last 6 months, right? We've had this COVID pandemic and that impact. And what people have found out is that, we can go through something like this and you can lose your job and you've got to be prepared for that. You could be an entrepreneur who's running a business that gets closed down and now you've got to sustain yourself and your family and your business probably. And if you don't plan and do the things necessary to get yourself through that period of time or that life event, then you're really potentially derailing your path to financial independence.
Right. You can't predict these type of events. You can certainly prepare for them, right?
Absolutely.
Yeah.
Absolutely. And we're going to go through a lot of those ways you can prepare. The second piece of financial independence for me that is often overlooked and I think as important as the first is the journey.
Right.
And it's really about freeing yourself of the fear and anxiety and stress that really plagues us as humans around money.
Yeah.
And the reason why that's so important is because when we put a plan in place and we get ourselves on the path to financial independence, it's very easy for us as humans to derail those plans. So if we're not focusing and paying attention to the emotions that come along with all of this, and the emotions that come along with investing and going through different life events and economic cycles and all of those things, if we don't pay attention to that, then we're going to derail our plan on the way to financial independence.
Absolutely.
And we won't get there.
Yeah, and that's what I love about your definition. So many people think financial independence as an outcome, and it certainly is, right? But we cannot ignore the component of having the right plan in place means the journey is just as important as the outcome, right? When you have a plan in place and it's the right plan, there's a lot of comfort, there's a lot of serenity that comes with that. And your relationships are improved, right? Money touches every part of our lives. So our relationships with our kids are better, our relationships with our spouses are better, our coworkers, anywhere that money touches our lives, if we have serenity around that, those relationships are improved, right?
Yeah. And that's achievable. It really is.
Yeah. For me, financial independence, I think about a situation I found myself in maybe a year and a half ago, where had a gentleman come to us, a potential client, and he was a partner in a law firm, right? And made fantastic money. But when he was walking in the door, he was doing so with almost no retirement assets set aside. And I look at myself and I think, how could that be? And as I dug in, he made great money throughout his entire career, but what he wasn't doing was putting a plan in place and putting it in early and sticking to it. Instead, he was enjoying his lifestyle, right? He was enjoying the trips that he was taking, the cars he was buying, the houses that he was renting. All of those things are all well and good, but if we don't also set aside a certain amount of money to be there for us in the future, you're going to end up in this position at 65 years old, not knowing where your retirement income is going to come from. And that's an uncomfortable position for a financial advisor to find himself in. And it's one that we hope through this webinar in particular, we can help people move away from and avoid.
Yeah, and get ahead of, because that is a completely avoidable situation.
Yep, absolutely. So let's talk about those steps that we can take, right? Let's talk about what the right steps on the right plan looks like. We're going to start off pretty basic, right?
Yep.
We're going to talk about savings, setting aside a certain amount each month, all these things. But then we're going to talk about some nuance, right? We're going to talk about financial science, which is a huge differentiator for us in the marketplace. Equius is staunch believers in financial sciences to get us to our destination, our desired outcomes, right? But let's start at that basic level. What are the first steps on the path to financial independence? What do those look like?
Well, the first step is get started. Get started today, right? Avoid where that attorney found himself. Get started today. So put a plan together. And again, it doesn't, when we sit down to go through our financials, we tend to avoid it because we look at it as this big complex thing and kind of this behemoth that we have to get our arms around. It's really simple. You sit down and you create a plan, you get a budget together, you get a savings plan together, and then you get an investment plan together. And I'll focus mainly on the savings investment piece of it because the budgeting is pretty hard, and it's one that I avoid. I don't like doing it. But what's most important is that you get started today with an automatic savings plan. We have a phrase here at Equius that we say, which is pay yourself first. So when your paycheck comes in at the on every month or every couple of weeks, the first thing you do is have an automatic savings plan so money comes out of that and goes directly into an investment account, right?
Exactly.
And a good rule of thumb to start with savings is about 20% of your paycheck. So if you're making $1,000 every 2 weeks, that's going to be $200 every 2 weeks that's going in to your investment account to be then deployed through an investment plan. And we'll talk about that, but I think
exactly. And I think that's what this slide really highlights. You don't have to set aside a massive amount of money in order for it to grow into a significant amount, right? By starting early, taking control of the power of time that you have on your side and that potential, you can set aside, as this slide shows, at a modest 9% growth rate, which we use as the general growth rate of the entire US stock market. So a pretty low barrier to entry here. But at $200 a month over the course of 40 years, you can achieve $1 million. You delay that. You delay, like the gentleman that I spoke of did, just 10 years, you have to more than double that amount to $500 a month, right? So you're playing catch up. You're putting more stress on your finances, which puts stress on your relationships, so on and so forth. And at the bottom, again, to highlight the power of compounding growth, if you were to set aside, to max out your 401k, you would essentially set aside $1,500 a month. If you were able to do that for the course of your career for about 40 years, that goes into $7 million. So a powerful amount that can have real life-changing implications when we need to rely on that money in retirement.
Yeah. And this is, you don't get time back, right? That is why you've got to get started now, and you've got to get started on a regular discipline plan. It's just like going to the gym and working out. You've just got to create habits that make it easy for yourself to take these steps so that you get started on it and then you stay on it. Because, life gets more expensive as we age. We buy homes, we start families. So taking it from $200 a month to $500 a month is not an easy feat, right? So that's really, really important.
Yep. All right, great. So let's now talk about what I alluded to, the financial sciences aspect, right? Because that is a really important component because it shows us the true right steps to take. And a lot of it flies in the face of what is common perception on how to invest today, right?
Yeah. Well, I think when we think about financial science, what we're talking about is, over the last 50, 60, 70, 80 years, there's really been an evolution in the way that markets are looked at, right? We're all familiar with the traditional ways that we can manage money: stock picking, market timing, trying to identify the right companies, trying to time when and out to get in and out of the market. And what the evidence has shown us over long periods of time is that those strategies have a very low odds of success and actually have a much higher odds of really deteriorating your wealth over time, right? And so there have been academics at University of Chicago, Dartmouth, Yale, Stanford, big institutions that have dedicated their lives to understanding markets and how they work and the dimensions of risk and return. And what risks are compensated, what risks are uncompensated.
That's a huge component, right?
Yeah, compensated risk being risks that you are fairly rewarded for taking versus those that you're unfairly rewarded for, or not rewarded for taking, right? So we have really, really robust data sets. We have solid state-of-the-art empirical research that has helped inform how we build portfolios and put the odds of success in our clients' favor, right? Not in Wall Street's favor, right? This is about making our clients money and having them grow their wealth over time and making sure that the odds of doing that and the fact, the reliability and predictability of them getting to those goals that they have is there. Right.
And financial science, what I love about it too, is it allows us to really adjust the knobs of risk and return, right? So no investment is appropriate for everybody, right? So we are able, through financial science, like you were talking about, understanding risk, understanding return, to pick the right investments in the right proportions to suit an individual investor's desired outcome.
Yeah, absolutely. Well, that's, and you only get the predictability around those dials through financial science, right? Everything else is really kind of a throw the darts at the wall, because financial science is what has allowed us to understand returns and understand risk, and then build portfolios around that understanding, right? And we can only get the predictable nature that we're looking for from that type of experience.
Right, exactly. And another aspect, so we've talked about financial science, we've talked about what it means to follow research and data. That's all well and good, but we understand there's a disconnect between the head and the heart, right? The emotion and the intellect. So that, I think, is another important aspect, is align yourself with a good coach.
Absolutely. I think when especially when I'm talking with younger professionals, you have time on your side to get started on the right savings plan, and you also have time on your side to really avoid the mistakes and pitfalls that a lot of investors make over time. And the only way you really become aware of those is through utilizing a coach and a financial advisor to help share those experiences and share that knowledge with you. And that is extremely important, because you can, there was a phrase that we've used before in this business: you can either get your education from us, or you can get your education through the market.
Right.
And I will tell you, the market generally gives education at the cost of a pretty high-end private school.
Absolutely.
So you can learn that way, or you can hire a fiduciary advisor, somebody that's there to put their interest ahead of your own, somebody that has eliminated all the economic conflicts of interest that you can have in a relationship. And what I mean by economic conflict of interest is, if I get paid to sell you this product versus I don't get paid to sell you this product, it's probably pretty likely I'm going to sell you this product, right? This is the one that puts food on my table. You got to get rid of those. So you've got to have, when you're looking for an advisor, you want full transparency. You want somebody that focuses on educating you, on providing you knowledge, helping you understand their philosophy and their approach. And you want somebody that can demonstrate that they have remained disciplined all throughout their history as an advisor and have adhered to their plan and to their investment strategy, and have done that for their clients.
Absolutely. And what that highlights, we're talking about good investment decisions, right? And a good investment decision over time, like young professionals have today on their side, turn into really great outcomes. But bad decisions, bad choices and pitfalls, if left unchecked, turn into really awful setbacks, right? Like the gentleman I shared. So let's start talking about those pitfalls that a lot of people that you've observed find themselves in?
Well, I'll take you back. Again, I think that the a lot of times it's about making sure that you've got a plan in place, and that you're behaving well throughout time with that plan. And then also just, again, making sure that you're aligning yourself with a coach to make sure you don't make those bad decisions.
Right.
Yep. And there's complexities. There's things, a lot of the young professionals on the call today, they have things like stock options and RSUs and just complex investment vehicles that come along with their human capital where they work. And it's important that they know that they make sure that they're making the right decisions to vest and exercise those options and understand the tax consequences.
Right.
So there's lots of pitfalls that people can fall into. But
Absolutely. Think of an example, if you could, of a time when you helped a client avoid a pitfall, because I think those stories are really, really powerful to help us understand how someone can find themselves in those positions and what an advisor can do to help.
Well, so I'll take you back to a client, a family that I have been working with now for a few years, and we had the March decline. It's a couple of architects, very smart people, have done very well for themselves over time, and all of a sudden COVID hit, and the market hit a big decline, and they're watching their portfolio decline, and they're close to achieving that financial independence. They're very close to getting to where they want to go. They're in their 60s and they want to retire, right? So it's extraordinarily important when we talk to folks, as we do education up front, but even along the way, as you said, things happen, and they weren't anticipating this, and they weren't expecting, they weren't mentally prepared for what was going to happen. So they came in and they wanted to sell out of their portfolio because they felt like that was what's going to satiate their feelings and what was going to get them to a place where they could, save their wealth in order to have that financial independence. And nothing could have been further from the truth, right? What's important, what we did with them is we brought them in, we coached them, again, took them back, shared our experiences and knowledge with them, and made sure that they understood that we have a plan in place, we've aligned it with your goals and objectives, and we've made sure that you are set up, and then we've taken them back through market history and made sure that they understood where we're going, and we kept them invested in their portfolio. And what did that do? That meant that 3, 4, 5 months later, they're virtually back to where they were, and we helped them avoid what would have been $1 million mistake and
huge.
Totally deteriorated their path to financial independence.
Yeah, and I think that's where, this is a really great slide where we look at, how a lot of people perceive the market, right? They see it on that 5-day aspect, that side of the slide, where the market undulates, right? There's a lot of movement here. And, of course, we understand that there's a lot of emotion wrapped up when the market moves a lot in any one direction. But what we really help people understand is the ride is more like that 5-year side. Don't lose the forest for the trees, right? We have to understand that we can see the undulating markets as an opportunity to buy, to sell, to get in, to get out. But the true way to achieve wealth through investing is by understanding the ride is overwhelmingly positive if you stay in your seat and you stay disciplined, right? And that's essentially what you did for this client.
Yeah, absolutely.
Yeah.
That is extremely important. So, behavior is a major pitfall. We talked about fear and greed, and you've really got to stay in your seat.
Yep, absolutely. So tell us what financial science then tells us about pitfalls to avoid. And for that, I've had a lot of conversations with my network, my friends, people that are young professionals, and there seems to be this perception that in order to make money in the market, you have to be good at picking stocks, at timing the market, finding the right time to get in, the right time to get out. But financial science tells us a completely different story, right? It flips that on its head.
Yeah. There's no more destructive strategy
behavior, right?
Than market timing to your overall wealth. And essentially, this really gets to the greed emotion and chasing the hot stocks and performance chasing. What financial science has provided us is the ability to just totally remove those things from the equation and focus more on how do we construct a portfolio with reliable long-term outcomes, right? You know, we live in a technology-centric area here. We've got, you know, Amazon, Google, Netflix, the FANG stocks.
The shiny objects.
The shiny objects. And people chase their performance and they get into them because they think that's what's going to lead to, you know, growing wealth, because they're looking at what happened the last 5 years. Well, what happened the last 5 years has no bearing necessarily on what's going to happen in the next 5 years. Right. And it's extraordinarily hard for stocks that have done 30% a year for the last 5 years to continue performance like that. So you've got to be really, really careful not to be seduced by those big high-flying stocks, and instead, you know, and the other thing you got to think about is as a young professional is to think about, we're not investing for the next 5 years or 10 years, right? This is long-term investing. You guys have 30, 40 years ahead of you. And it's important that if you think about it, if you're going to buy a basket of stocks today, at some point along the way, that basket of stocks is probably going to change. And do you really want to add that level of stress and, again, low odds strategy to what you're trying to accomplish?
Certainly. And what we're also talking about is, you know, concentrating into any one position. That's an uncompensated risk, right? People finding themselves investing their human capital, working for a company, but also investing in the company that they're currently with through stock options and all that. So
yeah, you've got to diversify your human capital with your financial capital. Without question.
And let's say, you know, you're not comfortable with taking on any risk, so you pull your money out of the market. Sitting on cash is a huge risk as well, because that is a depreciating asset. It loses, you know, its value every year to the CPI, to inflation. So we have to avoid, you know, stockpiling cash because we're fearful about what markets can do to us.
Exactly.
So let's look at this next slide here, because, you know, we talk about the fear, what it can cause us getting in and out of the market, and why having an advisor is so important. And, you know, here we've highlighted what can happen when you miss the best days of the market, right? When you miss the best performing days. And it may seem simple, hey, I can time the market, I can get in and out, but the data shows and science tells us the way to capture returns is by staying invested for these best days. So here we have, you know, the total return of the stock market since 1970. And if you were just to miss one of the best days there, you're cutting into your overall total performance, your returns, by about 10%. And we can move down the line here, but ultimately, since 1970, if we miss just 25 days since then, we're cutting into our, you know, our performance, our growing of our wealth in a significant manner. Here we see a little over 76% of our total performance is essentially eroded. Now let's set expectations here. Total performance is a measure of, you know, again, the total amount of return we get. It's not the maximum isn't 100%. It's, you know, if you, go ahead.
So essentially, if you could have made $100, you would have made 25.
Exactly.
Right.
Exactly.
If you missed the 25 days. So if you could have made $100, you only made 25.
Precisely.
Right.
Precisely.
So,
exactly.
That's what this is saying.
Yeah, very powerful. And there's no way you know when those days are coming. There's no way you know when you can time those sort of things.
Exactly.
So,
Exactly.
Absolutely. Well, now let's talk about the people who do not align themselves with a professional. They don't seek the expertise and this is an interesting part, because we seek out professional help in so many aspects of our lives. We have CPAs. When we're on sports teams, we have coaches. I mean, Tiger Woods, LeBron James, Serena Williams, even Tim Cook, Hillary Clinton, right, comes to mind. They all have professional coaches helping them drive towards their goals. So why wouldn't someone use a professional, an expert, a coach to help them with their finances? What could be more impactful than that?
Well, I think that what we find is there's a couple of things that kind of get in the way. And one is just the general lack of wanting to kind of pay attention to this stuff, right? And then there's also, you know, a lot of times we'll hear objections where I don't have enough money to work with a financial advisor. And you know, that could not be further from the truth, right? What we're about doing is about educating. I mean, education is in our DNA. We love educating folks and getting them started on the right path. And so we just completely, get rid of that barrier to entry, right? We have people that start with, you know, $25,000, $30,000, $50,000, or just get on a monthly plan to get started and get investing, right? So we get rid of that barrier right away. And then the other objection, not objection, but The other issue is people wonder, well, what's it going to cost,
Yeah.
and how is that going to be?
That can be tough to overcome, right?
Yeah, how is that going to affect? And what I would say is, when it comes to cost, and when I'm talking to a prospective client, that's on us,
Yeah.
right? That's what we have to do is show them that we're going to provide value, and that, we're numbers guys, right? So we understand that what we're trying to do is provide net value to clients over and above what they could do on their own. Yeah. And if we can't do that, then we shouldn't be their advisor.
That's our burden to bear. And oh, by the way, we've been bearing that burden and overcoming it for 30 years now. Yeah. So we're perfectly comfortable providing that value.
Yeah, but that's on us.
Yeah.
And what I would say, and this is what we tell folks, is that there's no harm in sitting down with an advisor. Yeah. Most of us that are fiduciaries and have have a real desire to continue to put this out into the marketplace, this way of investing. We don't charge up front for conversations and for planning and for understanding where you're at in your current situation. So it's there's really no harm in sitting down with an advisor to get at least an assessment of where you're at.
There is no reason why someone wouldn't pick up the phone or shoot us an email and say, hey, I just want you to take a look and let me know if I'm on the right path or not. Yeah. There should be no barrier for at least taking that initial step.
Yep. Yeah. Absolutely.
All right, so we're coming up on our time, so I want to respect the fact that all of you took your lunch hour, or at least a portion of it, to be with us today. So let's give these folks a quick hit list of action items to take from this. Yep. Things that they can do today, things that we've talked about, some things that we haven't, but what are those action items as you see them?
So the way I see it is kind of what we started with. Get started now, get a plan put in place, do things like maximize your 401k. If your lifestyle doesn't allow you to maximize your 401k, if your company offers a match, make sure that you get up to at least the company match. Get that automatic savings plan, so you're moving money automatically into an investment account, and then get an investment plan going. Sit down with a fiduciary advisor and have them educate you on how markets work. Have them educate you on risk and return, uncompensated risk versus compensated risk. Have them educate you on market cycles and what to expect and anticipate, and have them get comfortable with you being in an investment portfolio that is going to fluctuate over time, but that that whatever they've put you in aligns you with your goals. And then, there are, again, for folks on the call, there are a lot of little nuanced things that you want to make sure that you're doing if you have stock options, restricted stock units, diversifying your human capital and your financial capital, making sure that your 401k is invested properly. We see a lot of 401ks out there that just aren't that great as far as their construction, and you've got to get pretty creative in how you get them set up. So that's what I would say is really the hit list of things to do.
Yeah, exactly. So we touched on a lot of subjects today, and we weren't able to dive all the way in on a lot of them, especially when it comes to the financial sciences aspect, compensated risk, active investing and things like that. So before we go, just keep an eye out for more videos to follow that will dive deeper into those subjects. They'll be really informative, and I think you will enjoy them. So those will be coming. And again, we just both want to thank all of you for joining us today. Again, knowing you took time out of your day to be with us, we really appreciate it, and more to come.
Thank you.